European governments, they could combine all of their rescue funds to inject a massive amount of cash into the European economy. Bloomberg News has learned that pairing the temporary and the permanent rescue funds could total nearly €1 trillion. That's $1.3 trillion. All right, let's look at how Europe's crisis seems to be not monopolizing the global economy. My guests are Henley Smith, Chief Investment Officer, Commonwealth Asset Management, formerly Chief Investment Officer at Gabelli Fixed Income. Also with us, Jerry Webman, Chief Economist and Senior Investment Officer at OppenheimerFunds. Jerry, first to you. The news coming out of Europe, why does the market seem to lurch from one European headline to another? Don't we have enough to pay attention to in the United States?
Well, we do, but we're in a global financial system. So the fear is that a major accident on sovereign debt in Europe produces an even bigger and escalating accident in some European financial institution, which creates a liquidity and maybe solvency problem for another European and eventually a U.S. financial institution. So this cascading effect, as I like to say, and I don't mean this pejoratively, in our industry, we live in a house of cards. It's very fragile. And the question is, are we about to pull a card out? Looks like we're going to try very hard not to, but that's what the market, I think, is very nervous about, Pimm.
All right, a global house of cards, financial integration, Henley Smith. Explain how money market funds work, because many people park their money in money market funds.
That's true.
They think this is very safe. They're certainly not getting any yield by putting them in these funds, but there's a connection between money market funds and what goes on in Europe.
Well, true, and I'll just add to that, I think it's a game of Zynga, so if you pull out that one, it's going to stand, but it looks like they're going to pull something. But I would say that, from the money market standpoint, again, that was the asset class that was hidden in plain sight. It was really the Achilles heel that cascaded 2008. So I think what's happening now, specifically on the regulatory front, is that regulators are looking at money market funds, making sure they have enough assets and a cushion there to, if there is an event like that, that they can handle it. So you're seeing a lot of new stories.
But why would what goes
out.
on in Europe have anything to do with money market funds? Do the managers of money market funds take the money that people give them and go and invest in short-term paper in Europe?
Absolutely. That's one of the things, Euro commercial paper or bank, whatever it might be, that's all in money market funds here. So I think that's the real risk and concern. But I would venture to guess that since we've been dealing with this problem for the better part of 2 years now, that most money market funds here in the United States have kind of bulletproofed themselves to the point where I think that response would be fairly muted.
Well, you mean bulletproof themselves, what do you mean? Sold all of their European exposure?
Yes, and I think you saw that in the spring when this story started to rear its ugly head again, and they started to get out of those assets, and I think they've probably pulled their ship in a little closer to the waters here.
Jerry Webman, the idea of getting out of any kind of European asset, that can't be very good for European banks. Specifically, they want to raise more capital right now.
Right, and it can't necessarily, may not be really the right thing for investors to do as well, because at some price, these assets are valuable. Also, some of the Nordic banks, there are certainly banks in Europe that remain strong, and I think many money market managers have tried to diversify between the U.S. and some of the stronger European banks as well. So we wouldn't want to make the mistake of saying, oh, gosh, this is a European institution or European company and run away from it. That would be the wrong response, I think, for investors. You just got to be more careful, more prudent, do your homework a little more carefully than you have in the past.
All right. Well, having said that, though, I want to press you on what's coming out of countries like Finland, like Austria, like the Netherlands, and even some in Germany who are taking a look at the cost of these bailout funds and saying, wait a minute, this is an awful lot of money. And, once that money leaves, that means the power then leaves as well.
Listen, it's a big-time political problem. Europe imposed a currency, and I'll give you my blunt opinion here. It was a mistake to create the euro in 1999.
A mistake.
I think it was a mistake. I think that I understand the historical, ideological, why they'd want to do it. European integration is considered synonymous with peace.
A response to the Cold War victory?
Yeah, or a response to how many hundreds of years of war on the European continent. And how often have we had 65 years of peace in Central Europe? not very often. So I understand why they're doing it. The problem is it created a very fragile financial and crisis-prone financial system. We're in a crisis now, and countries really haven't come up with how much they're willing to compromise their own sovereignty, their own fiscal prudence, in order to hold this European experiment together.
Henley Smith, does this also mean a compromise when it comes to growth? Because Europe is not growing.
No, and I think the euro, in retrospect, might have been challenging, but I think going forward, it's something that has to happen. I mean, maybe the problem was that there wasn't strong fiscal responsibility in the euro. It was just a monetary union that came together. And you're right. I think that through traditional biases, there was going to be some fraying at the edges. But I think going forward, I think they're going to have it right. I think going forward, they compete better together than they do apart. And I don't think they want to go back to 1999 and compete individually. I think the world is more integrated, more interconnected, and I think Europe realizes that they do better together than they do apart.
All right, Jerry, you seem to be thinking that the Europeans are going to get their way out of this, but it's going to take an awful long period of time. You think Americans are going to wait?
Well, you know, it's a question is whether global financial markets are going to wait. After all, we carry some weight, but there's an awful lot of money that moves around in central banks and sovereign wealth funds around the world, and there is a question of confidence in these European financial institutions. So it does take a long time. Anything they do that restructures the euro, we talked about that between segments. It's going to take treaty renegotiation. So the question is really, is there patience in the financial system to get from here to there? And I think they're going to probably have to be a little more responsive in these short-term fixes. But I bet we see a bunch of short-term fixes. Maybe in the back room we're discussing something that restructures. You know, we try things like the euro. It doesn't work out perfectly. You've got to readjust it. There are centuries of experience with doing that kind of thing. And they're going to have to be able to balance the immediate adjustments with the long-term restructuring that's obviously going to happen.
Henley Smith, balancing the expectations of investors, that's going to be a big challenge, isn't it? I mean, how are you going to recapitalize the banking system in Europe?
And for investors, you know, it's just they're going to want more and more and more. The market, I mean, we saw it this week where they floated that balloon of 2 trillion euro, and it kind of fell flat on its face. So it's what day is it in Europe? But the market's going to continue to demand more and more. So I think they really have to come at it with a real big piece of the pie to solve this thing.
Do you think that Nicolas Sarkozy, the president of France, and Angela Merkel, you think they're in agreement? Nicolas Sarkozy comes out and he talks about the euro, and he really says, you know, those that are not backing all of these plans and are not backing the euro, this is almost calling for the destruction of Europe. I mean, it's quite hyperbole.
I agree, and I think it's a nuclear option that they don't want to push. It's, you know, mutually assured destruction. And I really believe that, as Jerry said, it might take some time, and there might be some trial balloons and back and forth. And I'm, for one, euro fatigued at this point. But I would say that there's really no real option going forward other than trying to make this work. And I think it's in everyone's best interest. And I think that's ultimately what they'll come up with.
Jerry, I like that term, euro fatigue. You think that investors are euro fatigued? So if they are, let's assume that they're following along with Henley Smith here. Euro fatigued, what do they do with their money while this plays out? Because this could literally take years.
It could take years. So you don't want your investments to be highly levered, highly geared to what's going to happen in Europe.
But I thought everything is correlated to what comes out of Europe
but you know what? It is on a minute-by-minute basis. It is if you have to do what we're doing tonight. If you're looking over who's creating economic value over a longer period of time, look at the nice earnings numbers we're seeing. There are companies in the U.S. and internationally are making money. At some point, investors are going to be rewarded by the fundamentals. And that's what I would tell people to do now. Focus on the fundamentals. You know, listen to us. It's a great show. But then go back and look at the fundamentals of what you're investing in and try to stay, as far as you can, away from what's going to create short-term headline risk.
Henley Smith, does this also mean that investors are going to have to learn to live with less? They're going to have to trim their expectations?
And I think that'll happen over time. I've met with a lot of clients that still have sticker shock in terms of returns. You know, they want 10, 15%. And that's just not going to be the way of the world, I think, for some time now. So I would stay engaged, stay in, with your markets, with your portfolio, have some flexibility with the markets, because we're going to continue to be dealing with volatility, especially as we go through this presidential cycle, which is going to be very volatile. But I would agree, you have to look at stocks on a very granular level. You have to look at investments on a very granular level to make sure that they make sense for you, they fit within your risk parameters, your liquidity needs. And if you build some market flexibility, you'll be able to weather the storm. And I think you'll come out of this much better. U.S.
Treasuries, about 2.19%. Let's call it 2.2% if you lend your money to the U.S. government for 10 years. Our own deficit reduction committee, they've got to come up with some credible plans just before Thanksgiving. You think they're going to pull anything out of the hat?
Well, I'm going to go with history and say we're going to fight over that and go to the 11th hour like we are now, and that's going to be very volatile markets, I think, coming up. I think we're still at very stressed levels in terms of 10-year note rates. We saw it got to 170 a couple of weeks back, which I think is way overdone.
You don't think we're going there again?
I think we're in a trading range. It could be 220 to 170. I think that broad range will continue to be defined. I think that range will start to narrow as we go through this process, and I'm going to bet that you're going to see 250 before you see 150.
250 before 150. Jerry Webman, what do you think about U.S. Treasuries? A fear trade?
I actually do think they're a fear trade. I think for most investors, they belong in the portfolio the way fire insurance belongs in your homeowner's portfolio.
You hope you never have to use it.
You hope you never use it, but you probably better own some, regardless of the price. Not because the return is attractive, not because it's going to make you money, but because it will be there as a cushion should you have a financial emergency yourself at a time when other markets are acting badly.
Does it also frame your almost financial psychology to have a little bit put aside?
Well, I hope people can think about things that way, that I've got this disaster insurance sitting here in a small portion of my portfolio, and therefore I have to worry a little bit less about what Monsieur Sarkozy says to Frau Merkel when they're getting together over the weekend.
Well done, Jerry Webman. I love that. Your accent is perfect. Jerry Webman, OppenheimerFunds linguist. All right. Henley Smith joining us from Commonwealth Asset Management. Appreciate your participation.